Okay, moving right along. Chapter 9. We're going to talk about tax credits. So, difference between a tax credit and a tax deduction. And we've mostly talked about deductions, although I think you had some tax return problems that may have involved the child tax credit, but they just kind of gave it to you. Although you had to do that worksheet, the child tax credit worksheet, so you've already kind of got a little preview of tax credits. But a tax deduction reduces taxable income. So it's essentially like all of our tax deductions are show up on the first page of the 1040 because we arrive at our taxable income at the very bottom of page 1 of the 1040, right? That very last line is where we calculate our taxable income. So if a tax deduction reduces our taxable income, that's all going to show up on the first page of the 1040, right? So a tax credit reduces our tax liability directly. It reduces our tax. So the tax credits show up on the second page of the 1040. Now, a tax credit could be a dollar for dollar reduction in tax, meaning you've gone through and figured out your taxable income and taken all your deductions that you're entitled to, and you've done the calculation of what your tax liability is, and you're entitled to a tax credit as well. It could be that that tax credit is going to reduce your tax liability dollar for dollar. So if you owe $2,000, your tax liability is $2,000, and you have a $2,000 tax credit, that means that you don't owe any tax because it reduces that tax liability completely, essentially eliminates that tax liability. The tax credit could be it may not reduce it dollar for dollar. It may reduce it by some other amount. So it may be based on a percentage. So for example, you get a 20% tax credit. It's going to reduce whatever that tax credit is calculated as. You then get 20% of it. So it's not going to be a dollar for dollar reduction. Now, there are two kinds of tax credits. There are refundable, and there are non-refundable. So a refundable tax credit can reduce your tax liability below zero, or reduce what you owe to below zero. Can. So that means that if your tax liability, let's say your tax liability is, I'll just use this guy right here. That's why I brought it out. So let's say your tax liability is $1,000. You've done the calculation, you've determined that you owe $1,000, but you have a refundable credit of $2,000. That means you're going to get a refund of $1,000. Even though you don't have tax liability of that additional $1,000, you're still going to get a refund. That's what they mean by it's refundable. It can result in a refund, even if you don't have tax liability. Now, with a non-refundable credit, it cannot reduce tax liability below zero. Meaning, So this one's refundable. If you have a tax liability of $1,000 and you have a non-refundable credit of $2,000, it will not result in a refund of any additional money. Essentially what that means is your credit is limited to whatever that tax liability is. Okay, so these refundable credits are extremely valuable. The refundable credits consist mainly of 3 credits. There is the earned income credit, which is kind of the granddaddy of all credits. It can result in huge refunds for families. Earned income credit, there is the American Opportunity Credit, and the child tax credit. The earned income credit is fully refundable. The American Opportunity Credit is partially refundable. The child tax credit is partially refundable, meaning part of that, only up to a certain amount can it provide a refund. So it's limited in how much of that refund it can generate, that additional amount, but the earned income credit is not limited in the amount of refund. It's kind of a misnomer, a refund, really, because a refund is something you paid it and then you're getting it back. But in this case, you really never paid it. So that's a little bit of a misnomer, but they call it that because it can result still in a refund of that individuals receive. So we're going to go through, we have a lot of tax credits in this chapter to look at. These 3 are the refundable ones, or have a portion of them that is refundable. All of the other credits that we're going to look at are non-refundable credits. Okay, so let's take a look, just kind of a brief intro to what the credits that we're going to talk about. Child and dependent care credit is the first one we're going to look at. Child and dependent care credit has to do with a credit for amounts paid for qualifying expenses on behalf of qualifying individuals to qualifying child care providers or care providers. So there's a lot of qualifying. There's a lot of words qualifying in there, so we have to determine what exactly qualifies. But the amount that's paid can result in a partial non-refundable refund or non-refundable tax credit to those who are entitled to it. There is this credit for the elderly or the disabled that we're going to go through. This one's not used all that often, and you'll see why it's not used all that often. It's very limited in its utility, but we're going to look at that one as well. Education credits. So this is one that a lot of students are interested in. There are a couple types of education credits. One of those is the American Opportunity Credit. There's another one called the Lifetime Learning Credit. So we're going to go over those 2 credits. Foreign tax credit. This credit is, you get a credit for amounts. Remember, let me back up. Remember that all income worldwide is taxable in the U.S. If you're subject to U.S. tax. That means that all of your worldwide income is subject to tax. Well, if your worldwide income is subject to tax and you have income from overseas, it's very likely that that income has already been taxed by some other country, right? So say you got a savings account in Canada and it earns interest, and Canada taxes that interest income. Well, the United States also taxes that interest income. Well, you get a credit for the amount of tax that you've already paid to Canada. There's a calculation that goes with it. It cannot exceed the amount of tax that you actually paid, but we're going to go through the rules for that foreign tax credit. Child tax credit. So this is another one that is partially refundable. partially refundable, partially non-refundable. This is a popular credit as well. This is probably, and this is a credit that had some changes to it with the new tax law, the new bill, I wanted to say Build Back Better. No, Big Beautiful Bill, lots of B's. That was just passed recently. They made some changes to it. We're going to talk about the changes that they made to it was they increased the amount of it, but we're going to look at the rules for 2024 and what they were, but I'll tell you a little bit about the new limit when we get to that. Retirement savings contributions credit. So this is a credit for individuals who contribute to retirement accounts if they meet certain income thresholds, and the income thresholds are fairly low, but if you meet that income threshold and you contribute to a retirement fund, then you can get an additional credit, as well as it being a deduction because it reduces your taxable income. You can get a credit for it. This is one of those rare instances where you may get to double dip and get two tax benefits from one deduction or one expenditure. So that's a rarity in the tax code, but that's one of those areas where that can apply. Adoption credit. There's a credit for individuals who pay expenses when they are adopting a child, and there are different rules depending upon the type of adoption. There's some special enhanced benefits for those who adopt special needs children. There are certain restrictions if it's a foreign adoption as opposed to a domestic adoption, so we're going to go through all that. The earned income credit, like I said, this is kind of the granddaddy of the credits. This can be a very valuable credit for individuals. It's a very popular credit because it is so valuable. It is a fully refundable credit, so individuals, and you can double up on the refundability of these credits or triple up if you qualify for all of them. There's still, you can get the benefit of all of them. So these can be really quite valuable to a lot of individuals. Now, as it says, it's earned income credit. That means you have to have earned income in order to qualify for it. So any type of income that was subject to Social Security and Medicare tax would qualify as earned income. Because these are refundable and can be extremely valuable, they also have a lot of restrictions on them. The IRS also places a lot of guidelines on tax preparers with regard to these tax credits as far as verifying taxpayer eligibility for them. So there are some pretty stiff penalties for violations for people who claim these credits who weren't entitled to them. And there's also some pretty stiff penalties for preparers who do not practice due diligence in confirming that taxpayers are eligible for those particular credits. So we'll talk a little bit about those as we go through. And then, I don't even know why this is here. Premium tax credit. Oh, I do know why it's here. Okay, I was thinking of the penalty. So the premium tax credit, which accompanies the Affordable Care Act, this is actually supposedly one of the reasons why government's shut down right now, is because these premium tax credits are associated with the subsidies that individuals receive toward their premiums if they are on the Affordable Care Act, or otherwise known as Obamacare. And you all know that the government's shut down right now, although you may not have even noticed. Sometimes it's not really very noticeable to me. I'm sure certain people, it's very noticeable to them. But it is about, there is a fight going on over these subsidies because they were increased during COVID, but they expire, the increase expires at the end of this year. That was built into the original bill that they would expire. There are, so the Democrats want to extend them. The Republicans have not said, no, we're not going to extend them. They've just said, we're not going to talk about that right now. We just want to get the government back open again. So this is actually pretty timely. This premium tax credit relates to those subsidies that are part of the government shutdown right now. So those are the things that we're going to talk about in this chapter. I'm going to scooch over to the intro page. I don't know. I think I've already mentioned pretty much everything that is on the intro page. Well, this kind of gives you an idea of the difference between a credit and a deduction. They've got an example here. We'll take a look at this real quick. So the deductions reduce taxable income, which then reduces tax liability, but it's going to be based on, that reduction is a percentage, obviously, and it's whatever that highest percentage, whatever the marginal tax bracket that they're in is. So for an example, a taxpayer has a $100 deduction if they're in the 24% tax bracket is going to save $24 in tax, right? If it's a credit though, if it's a $100 credit, then they're going to save $100 in tax because it's going to come right off of the tax liability. So it's kind of the difference between a deduction and a tax credit. They also go through the refundable versus non-refundable, and I think that's it. Okay.